So I think what you're going to see in 2025 is, as long as the U.S. economy continues to grow at 2 to 2.5%, the employment picture remains healthy, then the credit quality for the banks should remain healthy. Revenue growth should be positive. And then layering on top of that is a robust capital markets picture that could lead to stronger investment banking revenues and trading revenues. And lastly, the banking industry is very well capitalized. And as you just heard, Citigroup announced a $20 billion share repurchase program today. And all of the banks now will be actively buying back their stock because they're overcapitalized.
And is that a good sign? Buybacks are typically saying there's more value in the business.
Well, what happened? It's a good question, because the banking industry, as you know, is a mature industry. And the U.S. is a mature economy. This is not a growth economy like some of the lesser developed countries that have very rapid growth. And so what happens is the banks are so profitable that they're unable to redeploy all of the earnings each year organically at rates of return that shareholders would find acceptable. So it's very common for banks to give back 70 to 80% of annual earnings in dividends and buybacks because of the maturity of the business and the economy. So if this was a growth industry, of course, you wouldn't be buying back your stock. But this is one of the components of the shareholder returns that we've seen for a number of years, and we expect it to pick up in 2025 and 2026.
Yeah, Gerard, these banks are sort of hanging out in a house which has been described as the best in a bad neighborhood. And I suppose to your point that as long as the U.S. economy holds up, this is likely to continue. But what catalyst are you looking out for where that narrative might start to change in the outlook? Because, I was listening to Leslie Picker last quarter, and she was sort of suggesting that, investors and the market shouldn't be paying too much attention to what is happening right now, but more sort of in the medium term. I'm just sort of wondering when that medium term comes around.
No, it's a really good question, because there's always risks. And on a number of the earnings calls today, whether it was, with Jamie Dimon at JP Morgan or Charlie Scharf at Wells Fargo, those are the questions I actually asked, the one you asked, which is, what are the risks out there? Everything is setting up so well. Everyone's sharing this optimism for the banks. And I would say, aside from the obvious geopolitical risks that we're all aware of around the world of what's going on, but the real risk, I think, to the U.S. banks is the reemergence of inflation. And should inflation really come roaring back, and we're chatting here in the end of the second quarter results in July, and inflation in the United States is running over 4% rather than heading toward closer to 2%, that could force the Fed to change their position on monetary policy from monetary easing to monetary tightening. And should they have to raise short-term rates to fight inflation, that is the major risk to derail the bank stocks, in our opinion.